The Fed is really quite scared. I think they are completely on their heels when it comes to worrying about market risk. And at the first sign of a bank failing or a money market fund getting into trouble, they're going to fold. They're just going to capitulate.
Chris Whalen, Whalen Global Advisors chairman, author of the Institutional Risk Analyst, investment banker, and the best independent analyst that you will ever find on Wall Street, and a friend of this show. Great to welcome you back as always. We always love kicking off the month with you.
My pleasure, Julia. We've been getting fan mail from your listeners.
Well, I love that. Well, I have to say, our viewers and listeners, I always say they're the nicest people on the internet. And I know they love listening to you and seeing you on the show month after month. And I love reading the comments section when you're on. And I'm just really happy to hear that. Well, Chris, you know the drill. We always start with the big picture, that macro view of where we are in the economy. We've made it to September. I know there's a lot going to be happening this month. So let's just start there with the big picture. And as you know, you can take all the time you need to set the table when it comes to that economic picture.
Oh, sure, Julia. Thank you. I think the real issue that everybody's wrestling with in the last couple of weeks is there a recession or not? We just published a comment about the consumer lenders, the independents, really the big guys, American Express, Capital One, Ally, all of them. And you don't really see a compelling argument for a recession. In fact, the losses reported by these banks have been down 3 quarters in a row. So if there was a softening, I think it was in 2023. And I also think what we're seeing here, really, Julia, is there's still so much liquidity in the system. It's hard for it to slow down. I know that may not make a lot of sense because we know that the bottom quarter or the bottom third of consumers are really having a tough time. It is not a good time in terms of inflation, housing costs, all of it, right? But at the same time, you look at the bank numbers, and they may be releasing reserves next quarter because losses are so low. So, it's a strange time. I think a lot of the indicators are mixed. The employment, unemployment, payrolls, all of the rest of it that you follow, right? They're not giving us a clear picture. And I think that's the key takeaway I have about the macro environment.
Mm-hmm. Let me ask you this. So not a clear picture, but I am curious, like when this happened, when we saw that huge downward revision in the non-farm payrolls, what do you make of that?
You can't follow these data series month by month or quarter by quarter. You have to look at them over a longer period of time, in part because they get revised. I mean, we had a 3% GDP print last quarter. So what's that all about? How could this economy be expanding that way after 2 years of supposedly restrictive Fed policy? And the answer, Julia, is that the Fed wasn't restrictive. Home prices continued to go up. Powell was essentially cowed into submission 2 years ago when we had problems in the market, and he never recovered. So the market's telling Jay Powell what to do. I think it's very clear. And the idea that we have some huge recession coming at us, I think is a bit specious. Because think about it this way. If I'm Jay Powell and I get in front of the cameras and I say, well, we're cutting a quarter point or we're cutting a half point this month, how do I get up 6 months later if I'm still there, right? And talk about inflation if home prices are galloping at double digits. Because if the Fed cuts rates, home prices are going up next year. And they're still going up. They were going up all this year. So I think that is an optics issue for the Fed. How are you credible talking about 2% inflation if home prices go up 10 or 15% next year?
Yeah, I mean, it's great if you're a homeowner, except for I suppose you have other costs that come with the increase as well. Yeah. But it really stinks when you're someone who wants to buy your first home. And That's it right. Just, yeah.
Well, I have a new book out, as you know. It's a small, really fun biography of Stan Middleman, the founder of Freedom Mortgage. Stan is one of the smartest guys I know when it comes to the economy because he has 2 benchmarks, employment and inflation. He learned those 2 benchmarks from a guy named Paul Volcker, by the way. Mm-hmm. And Stan says we're not going to have a correction until 2028. We talk about that in the book. He says Fed's going to drop. They are. Home prices are going to surge for a couple of years. Then we have a maxi correction that looks like 2007, 2008. How about that?
What's that? Is that demographics? Is that boomers like downsizing? What's the correction?
We run out of buyers.
Okay.
Prices have gone up so much. Home prices have gone up 40% during the Biden administration. I don't know how they get up and talk about home prices on the campaign trail with Kamala Harris. It's just mind-boggling. Is it their fault? No, it's mostly the Fed. But the problem I always find with Democrats is that they're only able to talk about demand side initiatives in any part of the economy. They never talk about let's go out and build more homes, or let's get the states to change zoning so we can actually have more density in existing neighborhoods with, single family homes, by the way. That's the only way we're going to do this. We're not going to build more big apartment blocks in New York City to create affordable housing. You can't make New York affordable, Julia. That's why you moved. I mean, that's the whole point, right? It costs so much to acquire land, build property, and then maintain property in New York City. Why on earth would we encourage low-income households to move there? It makes no sense.
Yeah. So they need to focus on the supply side of things, I suppose.
Yeah, it's a complex issue, but think about it. If we're going to demonize home builders and developers, how are we going to get more housing? And you see this in all of the major blue states with large legacy cities, right? They create a political narrative that demonizes the very people who build housing. So how are we going to solve the problem if we chase them all down to South Carolina and Texas and everywhere else? That's the case. You know where all the developers in New York are today? They're in Florida. They're building stuff in Florida and they're making money. So,
yeah,
it is what it is.
I got to say, North Carolina is really nice, though. I love living here.
Yeah, but you know what? Charlotte has an initiative called Low Touch Development that allows people to put in mother-in-law apartments, that allows people to increase the density of single-family neighborhoods without going through a lot of political gyrations. In New York, if you build something, you got to pay every politician in the line. That could get very expensive.
This episode is brought to you by Public.com. Public.com has just launched its new bond account offering a 6.9% yield on your investment until 2028, when the first bond matures. Here's why it's interesting. Bond yields are currently at their highest levels since 2009. The Federal Reserve is meeting in September with potential rate cuts being discussed, and current estimates from the CME FedWatch suggest rates may fall as low as 3% by the end of 2025. The good news, investing in a diverse portfolio of corporate and high yield bonds could lock in today's historically high yields, even if the Fed cuts rates. Go to public.com to learn how to lock in this yield. The bond account, only at public.com/Julia. Let me go back to the first question, just where we are in the economy. And the question being, is there a recession or not? And right now, there isn't a compelling argument.
Not yet.
Not yet, but that's the key is like, what would cause us to start having that conversation? I mean, we are having that conversation, but
we are.
What would reinforce it for you or be the signals or the warning signs?
I think that we are so traumatized by 2008 and also COVID that the slightest sign of economic slowdown, the slightest sign of credit problems, sends everybody into a conniption fit. They don't know what to do. And I think it's a function of the fact that we're so used to bailouts and so used to safety nets that this population, and I'm talking about institutional investors, Julia, has no tolerance for pain. Mm-hmm. Can you imagine if the Fed had raised interest rates enough to make home prices go down? Like Paul Volcker, by the way? No. We don't even begin to have the capacity to do that from a policy perspective. So recession is merely slowing down a little bit. We're running this economy hot. If you look at how much we're borrowing in terms of the federal budget deficit, what would this look like if we didn't have a deficit? We would probably be in a slow, if not a stagnant economy. Mm-hmm. So how do we measure these old-fashioned notions of recession expansion when so many of the guideposts we have are really not functioning? People talk about the yield curve as a predictor of inflation. That went away 20 years ago. The yield curve is owned by the Federal Reserve Board. So I think that we have to be very careful reading this data that we get every day from the media, because it may or may not be telling us what we want to know. I can say this, banks are not losing money on credit right now. And either they're hiding it, or maybe they're complicit with their auditors. I don't believe that. Or maybe they're just not seeing the losses yet. The peak in losses for banks in the last couple of years was at the end of 2023.
Mm-hmm.
So
Yeah.
really the third quarter, when mortgage rates peaked at 88% in the U.S. for a whole week, Julia, that's when the recession peaked and ended, I think.
Yeah. You mentioned like Wall Street doesn't really have this tolerance for pain. And
No.
all right. So I guess like after we got the downward revision, there were, even after we had the issue with the Japanese yen, market sell-off, there's a lot of talk of like, I even heard people talking about like, oh, maybe we need an intra-meeting rate cut, or we're going to get rate cuts in September. Even Powell's speech and Jackson Hole kind of
I
signaled that they're on
know.
the table. So
Isn't
let's
this
talk about
ridiculous?
that. Would that be a mistake to cut this
Yes.
month?
Yes. I think the Fed has a problem, which is if they cut rates a couple of times and we get a bad print on inflation, what are they going to do? I think they should try and do as little as possible. So if I were sitting in the chair, I would like to see Fed funds go from 5.5 down to about 4.5. That's more than enough breathing room for the street. We could get asset-backed securitizations restarted. There's some other important things that would help. It wouldn't really help commercial real estate. That's a very specific, idiosyncratic market, and each building's got a story, so that's not going to help. And then, the consumer, I don't think they would get much relief from a full point rate reduction, say, over the next 12 months. They're still going to be paying 20+% on their credit cards. But at the same time, home prices are not going to move. If anything, they'll go up. And that, to me, is the saddest part. So we're not giving young home buyers, young families, an opportunity to get in at the bottom of an economic cycle because we don't have bottoms of economic cycles anymore.
Mm-hmm.
The Fed maintains this artificial stability, and they keep telling us, oh, we got it, we're in charge. But then we have a lot of examples, don't we, Julia, where they're not in charge and where they're really not in control of things. So I'll give you an example. If you go back to COVID and come forward to today, despite all of the movements and all of the talk from the Fed, bank reserves haven't moved. They've been so afraid to contract liquidity in this market since the problems we had in 2023 with the banks that they've basically taken a soft approach to managing for inflation.
Mm-hmm.
The Fed is really quite scared. I think they are completely on their heels when it comes to worrying about market risk. And at the first sign of a bank failing or money market fund getting into trouble, they're going to fold. They're just going to capitulate.
Wait, elaborate a bit more on that.
Well, look, in 2020, the Fed had to come in and buy $2 trillion worth of Treasury bonds because the market collapsed. People really don't focus on this, but this is what happened. There's a number of researchers who've written about this. And I think because of that, the Fed is so chastened by the prospect of a massive sell-off in both the equity markets and the fixed income markets that they are afraid to really fight inflation. They are far more worried about liquidity than they are worried about inflation.
Mm-hmm. Yeah. Okay. So this might be a nice segue because I got a viewer question and they were like asking me to ask the right guest. So maybe you're the right guest. Sounds like.
Uh-oh.
So this comes in from a gentleman named Mike, and he just said he would like to have a better understanding and hear addressed. I've heard many times that liquidity is, quote, injected into the economy. I would love to hear specifics on how money actually gets there. I know the questions are silly, but it's not silly. None of these questions are silly, you guys. But this is the only way I would know to convey what I mean. Does the Fed call the banks and say, "Hey, we have some money. We need to get into circulation"? Who decides how much the banks get? Then how much does it get into the hands of investors or people circulate it? Does someone like Goldman Sachs say, "Send us $1 billion," then they invest? Is the injection always loans? I understand during COVID when regular people got checks, but typically how does money flow from Fed to circulation? Then how do they restrict the supply? I hope this makes sense. Thank you so much for all the work you do. Mike, do you think we could help Mike out here?
Of course we can, Julia. That's why we're here. Basically, the way the Fed adds money to the economy is by increasing reserves. What are reserves? Reserves are deposits that banks keep at the Fed. So let me give you an example from recent history. When the Fed was buying bonds for its portfolio, they would go into the market, contact one of the dealers and say, hey, we're buying 10-year Treasury bonds. The Fed would buy the bond, and then they would credit the bank's account with cash. Reserves go up. Bank deposits go up. So this is a very simple example of how the Fed adds liquidity to the system. Now here's the rub. Will that bank, one way or another, make that cash available to the rest of the market, or will they sit on their hands? At the end of 2018, JP Morgan, Wells Fargo, the rest of them basically sat on their hands. They saw that the Fed was reducing reserves. They saw that deposits were shrinking. And they said, well, we're good. We're going to close our books in the beginning of November, and we're not going to provide any more liquidity to the market. And we had a big problem at the end of December 2018. So today, the Fed has been very gently trying to shrink their balance sheet, which means they're not buying bonds anymore. Every time a treasury bond that the Fed owns matures, they give the bond to the Treasury. The Treasury gives the Fed their cash. And what happens? The Treasury immediately has to go out and reissue another security. They got to go get their dollar back, right? Because they have a deficit. They have to immediately go sell a new bond. A bank deposit disappears because that investor goes out and buys that bond from the Treasury instead of the Fed buying the bond. And what happens? The investor now owns a Treasury bond, but the bank deposit has disappeared. So the total liquidity in the system shrinks. So when the Fed buys securities, the system expands in terms of liquidity. When they sell securities, the system shrinks. That's now the big tool of monetary policy. It's not the Fed funds rate. It's not what they say at the press conference. It's the Fed's management of their balance sheet. And frankly, Julia, it's a concern because this is brute force. This is like the Bank of Japan managing their yield curve. And this is really what happened since 2008. The Fed has adopted more and more aggressive, more large-scale open market operations. And essentially, they've taken over the whole fixed income market. So that's the answer to your listener's question. I'm writing about this in the book, by the way. When I reissue Inflated next year, we'll have a whole chapter on this.
Okay. Wait, so you're doing are you doing several different chapters that you're revising?
Yeah, I just put one in because Inflated was published in 2010. So we really needed to cover the 2010s up to current, times, about 15 years, but very significant time period because you had a very slow period for a while after 2008. It was a lot like the 1990s, not a lot going on in housing, very slow economy. And then it started to recover. But we had a couple of hiccups, 2018, 2020 with COVID, and each one of these resulted in some big shocks to the financial market. And as I said before, this crowd is not looking for shocks right now, Julia. Americans, I think, more and more are looking to be bailed out. They don't want to be subject to market forces. That's the last thing they're looking for.
That's what I don't quite understand is why not just let the shocks happen? Why all the intervention?
Well, it's interesting. There was a gentleman who came out with a paper the other day talking about how we shouldn't allow JP Morgan to buy First Republic Bank. The FDIC allowed that transaction because they said it was the least cost resolution for the bank. The gentleman said, well, we shouldn't do that. We're getting concentration in the banking industry. Jamie Dimon doesn't need to get any bigger, right? Fair enough. But the problem, Julia, is that there was nobody else going to buy that bank. It was just like the situation with Bear Stearns and JP Morgan. JP Morgan was the lender to First Republic. They bought loans from First Republic. So if the FDIC had said, well, JP, you can't buy them, we're going to just liquidate the bank, that would have increased the cost dramatically. And FDIC didn't have the cash. It's hard to sell dead banks unless interest rates are falling. Remember 2008, 2009? Very easy to sell dead banks because the Fed had already dropped interest rates. There was a profit baked into all of those transactions. And the FDIC gives you some equity when you buy the assets anyway, because they have to. But the bottom line is that today, if another bank failed, it would be really hard for the FDIC to find a buyer. So to come and beat your chest and worry about how the banking industry is getting too concentrated, well, that horse left the barn 20 years ago. As long as we have inflation as the major fixture of public policy when it comes to finance in this country, then you're always going to have banks getting bigger, and you're always going to have banks that are not profitable and that are kind of problematic. And what do we do with them? It reminds me years ago when Manufacturers Hanover kind of fell by the by. I was working at the Fed in New York. There was only one buyer, Chemical Bank. Nobody else wanted it. And if you liquidate those assets, Julia, to get to your question, right, bad things happen. Irving Fisher, the great economist, if your listeners Google Irving Fisher 1933, you'll see an essay on the website of the St. Louis Fed that talks about debt deflation. When you have a shock to the system and money leaves the market, the asset prices fall. And if you don't have somebody come in and catch them, they'll keep falling. And you will destroy an awful lot of economic value along the way. This is what happened in the 1930s. We had 10 years of deflation. Anna Schwartz and Milton Friedman documented the fact that just about all of private debt in the United States disappeared in the 1930s because nobody wanted to take risk. So that's what you want to avoid.
Yeah.
And as much as I hate bailouts, as much as I hate seeing bad institutions getting bailed out and sold, imagine if they had imposed losses on the depositors of Silicon Valley Bank. What do you think the market would have done the next day?
Yeah.
Imagine if all three of those failures had not been an arranged sale, Signature Bank, Silicon Valley Bank, but instead we just liquidated them.
Mm-hmm.
We would be in a depression right now.
Yeah. Okay. But I guess do you get to the point where you kind of have to do the intervention almost every single time because if you don't let any little hiccups happen along the way, you got it. It's just build up to where it's going to be okay, you have no choice.
I think that's right. But, Tom Hoenig sent me a note a while ago, the former head of the St. Louis Fed and the FDIC. And he said, Chris, we've lost market discipline. There is no longer any market discipline. So in a situation like that, if you try and reimpose discipline, if you got tough with bank failures, for example, and you didn't pay out all the depositors, if you made them wait until there was a recovery on the estate of the dead bank, which can take months, you would kill confidence. See, this whole system works on confidence. We have a fiat currency. We have a fractional reserve banking system. Even the FDIC works on a little bit of capital and a lot of confidence. So if we start damaging that with bad policies, we're going to wake up one morning and the ATM machines won't work and your credit card won't work. And the kids are going to look at you and say, hey, mommy, I want breakfast. And what are you going to do? So unfortunately, bailouts are actually more economically efficient than debt deflation. Mm-hmm. Okay? Just think about the ATM machines not working anymore.
Yeah. 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 I want to just go back a little bit more on the Fed. I know you don't think they should cut, but do you think they're going to cut?
Yeah, I think you got to give the market what it wants to some degree. But let's say we did a quarter point this month. They're going to probably wait in October because it's right in front of the election. Mm-hmm. Maybe another quarter point in November, 2 more next year. Get Fed funds down to, like I said, 4.5. But the question is, what happens to the rest of the yield curve if the Treasury is out borrowing $800 billion every 3 months? I think we will see a normal yield curve for the first time in decades, which means long-term rates will be higher. So we may not get a bump on housing. We may not get mortgage rates to fall very much. And that's going to be a big question next year. But even if they fell little, imagine if we were writing 5.75% mortgages, say 6 months from now, home prices will go up a lot.
Yeah.
And that's going to be a problem for the Fed.
And that'll be because of the demand. Suddenly it's rates are lower. There'll be people
housing is a constant. People need a place to live.
Mm-hmm. Yeah, you're right. You mentioned longer term rates may be higher. Are you talking about the 10-year?
Yeah, 10s and outs.
Okay. Well, do you have an outlook as to how high you see that?
Well, I think it's clear the 10s could run down considerably because everybody on the street got out of stocks and they're now deployed for an interest rate rally. But as people take profits, I think you're going to see the bonds go back up in terms of yield, because until we get the deficit under some kind of control, I don't see how people could expect long-term rates to stay down.
Mm-hmm. Yeah. Okay. And speaking of the deficit, We talked about that briefly the last time, our debt situation, the deficit spending and whatnot. Would love to just get more of your thoughts there. Is there a path to get it under control that's realistic?
Well, the realistic path, I think, is for a president to at least have one house in Congress and to look at them and say, guys, we need budgets from all of the relevant committees. We're not going to increase spending 10% this year because we're going to just pass a continuing resolution. Congress is not doing their job. They need to do a budget. And you might even examine doing a freeze across the board for discretionary spending, simply because there's been so much increase over the past few years. If the president had limited power to reprogram funds, they could easily manage it. Defense is a big area, obviously, because all of the big defense contractors are looking to make money on the Ukraine war and Israel and Middle East and everything else, Taiwan. So there's going to be pressure for higher defense spending. But I think you got to just get Americans to take balancing the budget seriously. I think it requires giving the executive branch some kind of line item veto. Mm-hmm. And I also think the other part of it that's very important, aside from Congress getting back to work and actually producing budgets every year, is for them to score what's important. What's important to your constituents? What programs do you really want to see? And if you force that, guess what? Once you figure out the ones that are not important, you can start cutting them.
Yeah.
I would like to see us cut the bottom 5 to 10% of federal spending every year, and amazing things would happen. But the key thing, Julia, is remember this country is very wealthy. The assets of the United States are measured in the hundreds of trillions of dollars. So is the $35 trillion debt a problem? Yes, it is. But it's not an existential problem. Mm-hmm. And it can be fixed if we have people who are serious. We've had a lot of people who are not serious in Washington over the last few years. I grew up in Washington, so I'm allowed to say that. I worked for Fritz Hollings and I worked for Jack Kemp. Fritz Hollings is my kind of Democrat. So.
Yeah. When you say also, just real quick, when you say like line item veto, that's like going through and just like taking out like the pork barrel when legislation, we see stuff like shoved into bills.
Yep. Force them to get a 2/3 vote. And again, if you ask members of Congress what's important, if you force them to score every item in the federal budget based on their constituents, it's very easy to figure out what you can cut. Right?
Yeah. Yeah. It's smart.
Yeah. I'll volunteer. I'm happy to do it.
I would love, you know what? I think we would be a lot better off if we have folks like yourself. I'm just saying, we really.
Well, compare Carter Glass, the great Secretary of the Treasury during World War I, and the senator who passed Glass-Steagall, right? You remember him. But he managed Congress during the Great Depression. Compare him and Janet Yellen. Okay? Janet Yellen's a lovely lady, and she has a great interest in housing, which I really appreciate from her. But she's not the kind of Secretary of the Treasury we need right now. We need somebody who understands finance and who understands how to manage a situation where you may not always have the ability to borrow. We already had one busted Treasury auction in the first quarter of 2020. We're going to have another one, Julia, and we need to be prepared for that.
Yeah, certainly. We have a few minutes left here. I think the last couple of episodes I've asked you this, and you've certainly been open. The upcoming presidential election, latest thoughts there? Anything that you want to weigh in on, especially as it relates to the economy, markets, expectations around the election even?
I think the American public is very confused because I don't think they care for either one of the choices we have. I personally am going to support Trump because as much as I am horrified by some of his flaws, I am even more concerned with the Democrats. The Democrats I knew and loved back, a long time ago, had a plan for running the country. They had a long-term plan beyond just winning elections. And I think that's what we've got to get back to, because if we don't have people who take running the country in a nonpartisan way as their first job, then I don't want them in public office. If they're just looking to get to the next cocktail party, I think we can find something else for them to do. So my hope is that this election is going to focus people on the budget. I think it's interesting that Trump wants to turn Elon Musk loose on the federal budget, which is not a bad thing. I think an outside view from somebody who's clearly an astute business person on what the federal government is doing with our money is not a bad thing. But I also think there's a need for, not making enemies in the business community simply for political gain, whether you're looking for new homes for people or you're looking at how we run financial services in this country. The politics I've had to work through in the last 4 years. I work with lenders. So Treasury, the big housing agencies in my neighborhood. And I am not impressed by what I see. We have got to get better people who have subject matter expertise. I don't care who they are, what political party they belong to. I want them to be competent. Because we've had a whole collection of very attractive people with wonderful table manners in the Biden administration who are clueless about finance. And it shows in the proposals they come up with. Kamala Harris came out with that tax proposal, and, she's begging every businessman in the country to run against her. She's begging every institutional investor in the country to support Trump. So I think we have to tune policies that are going to promote growth, promote well-being, and maybe even lower inflation, right?
And price controls do not work, have not worked.
Well, this is the thing. I mean, you have people in this city who are hurting. They can't even afford to live in this town because it's so expensive. So the progressive politicians come up with rent control. But the problem is that's not going to stop the cost of running that building from going up. There's nothing they can do about that. So either you work with the builders, you work with the developers, and you try and figure out a way to treat people fairly. Or, we're going to have a problem. I think we need another Bob Moses, really. We got to go find him. I'm sure he's out there somewhere. Another brilliant mind with public administrative experience, maybe a little architecture. Because, half of New York City needs to go bye-bye, Julia. You know what I mean.
Yeah, I know what you mean.
It's 150, 200 years old. It goes back to when my ancestors got here. My dad's people came to the United States in the 1780s. So those buildings down in Brooklyn, where my great-great-grandfather used to live, are still there. We need to redevelop a lot of these urban areas for the 21st century. And that's going to take big money. So you want to fight about something? That's a good thing to fight about.
Yeah, certainly. Chris, we always love having you on the show. I look forward to it every month, and I always learn something new. I want to give you the final few minutes here, or you take as much time as you need. Obviously let folks know where they can find you, read more of your work. Now you have books, Inflated's being rewritten. You have your Stanley Middleman book. Anything that you want to plug, and also just any parting thoughts that you'd like to leave with this audience to think about until the next time we have you on?
Well, I'm going to dedicate the new edition of Inflated to the Americans. And the reason I'm doing that is that regardless of all the problems we think we have, this country is still way ahead of the world. That's why everybody else in the world wants to come live here. It's also a comment on the countries they live in that are not very well run. We have to fight to continue to run our country in a rational and a fair way. And there is a way to do this. So, that's my thought. I'm not at all pessimistic about the future. I think that we have a lot of possibilities. We just have to realize that our economy and our political system is for the highest bidder. We are a commercial society. We are conflicted everywhere. We have conflicts. So if we accept that, then I think we can move forward. Anyway, you guys can find me at the Institutional Risk Analyst. That's my blog. I publish a lot of other stuff on rcwhalen.com on X. I don't do Facebook. I'm sorry.
That's okay.
I publish a column for National Mortgage News every couple of weeks, and I work with a lot of lenders and mortgage companies. So get in touch. We're always happy to have questions.
And folks can leave questions in the comment section as well that we get to next time, or you can even email me. I appreciate you taking the viewer's question. I actually didn't know who I was going to put that to, and I thought you did a phenomenal job answering and helping all of us understand. And there's no such thing as, silly questions. I think we're all trying to learn and get better. And so I always welcome them.
It's just a time. I take questions from people on X because it's easier to do. I don't do comments on the website because I don't have time. I'd have to hire somebody to police the playground, right?
Yeah. Well, you can send them my way and then I can put them to you next time you're on.
No, don't say that. You don't want to do that.
We'll see. Okay. Well, Chris Whalen, chairman of Whalen Global Advisors, author of the Institutional Risk Analyst. Always, always a pleasure having you on the show. I look forward to it every month. Great to see you again. Thanks so much, Chris.
Okay, see you next month.